Question 1, normal practice question. Topic, risk management and underwriting. A captive insurance company is deciding whether to retain or transfer certain risks. Which of the following factors should the company prioritize in making this decision? A, the total premium revenue generated by the captive. B, the likelihood and potential financial impact of the retained risks. C, the number of insured parties under the captive. D, the historical performance of the captive's investment portfolio. Answer: B, the likelihood and potential financial impact of the retained risks. Explanation: B, correct. Risk retention and transfer decisions hinge on the probability of losses and their potential financial impact. Captives are designed to manage predictable and manageable risks while transferring catastrophic risks to reinsurers. A, incorrect. While premium revenue is important, it does not directly inform risk retention decisions. It is more relevant for financial health analysis. C, incorrect. The number of insured parties does not directly correlate with the risk level unless it affects aggregate exposure. D, incorrect. Investment performance is crucial for overall solvency but does not dictate risk management strategies directly. This question reflects the principles of risk retention and transfer, a core concept in captive insurance management. Question 2, scenario question. Topic, New Jersey regulatory framework for captive insurance. Mr. Harrison is establishing a captive insurance company in New Jersey to provide liability coverage for his logistics business. After submitting his application to the New Jersey Department of Banking and Insurance, DOBE, he receives feedback that his proposed governance structure lacks compliance with state regulations. Mr. Harrison plans to appoint his nephew, a part-time employee with no insurance expertise, as the sole director of the captive. What should Mr. Harrison do to ensure compliance with New Jersey governance requirements? A, appoint at least 2 additional directors with relevant insurance or financial expertise to the board. B, shift the captive's jurisdiction to a state with fewer governance requirements. C, resubmit the application with his nephew listed as a consultant instead of a director. D, abandon the captive formation and purchase traditional insurance instead. Answer: A, appoint at least 2 additional directors with relevant insurance or financial expertise to the board. Explanation: A, correct. New Jersey law mandates robust governance, including appointing qualified directors with relevant expertise. This ensures sound decision-making and compliance with fiduciary duties. B, incorrect. Shifting jurisdictions does not address the root issue of inadequate governance, and New Jersey may still require compliance with its initial licensing requirements. C, incorrect. Listing the nephew as a consultant does not solve the underlying issue of governance compliance, as he would still lack the necessary qualifications for decision-making roles. D, incorrect. Abandoning the captive is unnecessary when compliance adjustments can be made to meet regulations. This scenario emphasizes the importance of governance and management requirements under the New Jersey Captive Insurance Act. Question 3, normal practice question. Topic, taxation and financial considerations. A New Jersey-based captive insurer is evaluating whether to make an 831(b) election for federal tax purposes. Which of the following conditions must be satisfied to qualify for this election? A, annual premium income must exceed $5 million. B, a captive must be a group captive insuring at least 3 unrelated parties. C, the annual premium income must not exceed $2.65 million as adjusted for inflation. D, the captive must provide only property insurance to its parent company. Answer: C, the annual premium income must not exceed $2.65 million as adjusted for inflation. Explanation: C, correct. Under IRS guidelines, an 831(b) election is available to captive insurers whose annual premium income does not exceed $2.65 million adjusted for inflation. This allows the captive to be taxed only on investment income. A, incorrect. Premium income exceeding the limit disqualifies the captive from making the election. B, incorrect. The election applies to single parent and other captive structures, not exclusively group captives. D, incorrect. The type of insurance provided does not limit eligibility, though the captive must comply with IRS rules regarding risk distribution and risk shifting. This question assesses understanding of federal tax implications and the requirements for making an 831(b) election. Question 4, normal practice question. Topic, formation and operation of captive insurance companies. A feasibility study for a captive insurance company includes various considerations. Which of the following is least likely to be part of the feasibility study? A, projected claims frequency and severity for the insured risks. B, analysis of local competitors in the traditional insurance market. C, capitalization requirements based on regulatory and business needs. D. Financial modeling of potential risk retention scenarios. Answer: B. Analysis of local competitors in the traditional insurance market. Explanation: B. Correct. While understanding the broader insurance market is beneficial, detailed analysis of competitors is not a primary focus of a captive feasibility study. Feasibility studies are designed to assess the captive's internal viability rather than external competition. A. Incorrect. Claims data is critical for assessing the financial sustainability of the captive. C. Incorrect. Capitalization requirements are a key regulatory and operational consideration. D. Incorrect. Financial modeling is essential for determining the captive's capacity to retain risk. This question focuses on the foundational knowledge of feasibility studies for captive formation. Question 5. Scenario question. Topic: Legal and compliance issues. MS Patel, the CFO of a captive insurer in New Jersey, discovers that one of the policies underwritten by the captive was issued without conducting a thorough know your customer check. This oversight violates the captive's compliance policies and state regulations. During a regulatory audit, the auditor flags this issue. What should MS Patel do to address this situation? A. Immediately terminate the policy and notify the policyholder. B. Conduct a retrospective KYC review and submit a compliance report to the regulator. C. Wait until the audit is complete before taking corrective actions. D. Cease all underwriting operations until a full internal review is conducted. Answer: B. Conduct a retrospective KYC review and submit a compliance report to the regulator. Explanation: B. Correct. Conducting a KYC review retroactively and notifying the regulator aligns with compliance best practices and demonstrates the captive's commitment to addressing lapses proactively. A. Incorrect. Terminating the policy could lead to legal and financial repercussions if coverage obligations are unfulfilled. C. Incorrect. Delaying corrective actions increases the risk of regulatory penalties. D. Incorrect. While an internal review is valuable, halting all operations is excessive for an isolated issue. This scenario examines knowledge of AML and KYC requirements and practical compliance strategies in captive insurance. Question 6. Normal practice question. Topic: New Jersey-specific captive insurance policies. Which of the following is a unique requirement for captive insurance companies operating in New Jersey? A. Mandatory membership in the National Association of Insurance Commissioners (NAIC). B. A business plan must be submitted annually to the Department of Banking and Insurance (DOBI). C. Captives must exclusively insure risks located within New Jersey. D. The minimum capital and surplus requirement is $1 million for all types of captives. Answer: B. A business plan must be submitted annually to the Department of Banking and Insurance (DOBI). Explanation: B. Correct. New Jersey requires captives to provide annual updates on their business plans to DOBI to ensure ongoing compliance with state regulations. A. Incorrect. Membership in NAIC is not mandatory for captives. C. Incorrect. Captives in New Jersey may insure risks outside the state, subject to regulatory approvals. D. Incorrect. While capital and surplus requirements exist, they vary by captive type and are not always $1 million. This question highlights state-specific requirements for captives in New Jersey. Question 7. Normal practice question. Topic: Taxation and financial considerations. A New Jersey captive insurance company calculates its premium tax. If the company's annual written premium is $5 million and the tax rate is 0.38% for premiums up to $20 million, what is the total premium tax liability? A. $15,000. B. $19,000. C. $18,000. D. $19,500. Answer: C. $18,000. Explanation: Premium tax is calculated as follows. Tax liability was premium written x tax rate substituting values. 5 million x 0.38 equals 18,000. A. Incorrect. Calculation error or incorrect assumptions. B. Incorrect. Overestimate of the tax liability. C. Correct. The calculation aligns with the tax rate provided. D. Incorrect. Does not match the correct formula output. This question assesses understanding of premium tax calculations for New Jersey captives. Question 8. Scenario question. Topic: Alternative risk transfer mechanisms. Mr. Liu's captive insurance company in New Jersey wants to mitigate high-severity risks associated with cyber liability. The captive's risk manager proposes entering a fronting arrangement with a traditional insurer. The traditional insurer will issue policies to insured parties and reinsure the risks with the captive. What key factors should Mr. Liu consider before finalizing the fronting arrangement? A. The financial rating and solvency of the fronting insurer. B. The size of the captive's claims management team. C. The captive's total underwriting profit from previous years. D. The number of unrelated parties insured by the fronting arrangement. Answer A. The financial rating and solvency of the fronting insurer. Explanation A. Correct. A fronting arrangement depends on the financial stability of the fronting insurer. If the insurer is not solvent or has poor ratings, it can jeopardize the captive's risk transfer strategy. B. Incorrect. Claims management is important but secondary in this context. C. Incorrect. Past profitability does not directly affect the viability of a fronting arrangement. D. Incorrect. The number of unrelated parties is irrelevant to fronting agreements, which focus on risk-sharing dynamics. This scenario explores fronting arrangements and risk transfer mechanisms. Question 9. Normal practice question. Topic: Emerging trends and challenges in captive insurance. How are captives adapting to the increasing risk of cyber liability? A. By reducing their exposure to technology-based risks. B. By developing customized cyber insurance policies tailored to their parent organizations. C. By shifting all cyber risks to external reinsurers. D. By exclusively covering non-technology related risks. Answer B. By developing customized cyber insurance policies tailored to their parent organizations. Explanation B. Correct. Captives often craft bespoke policies that address specific cyber risks faced by their parent entities, leveraging their flexibility. A. Incorrect. Reducing exposure contradicts the risk management purpose of captives. C. Incorrect. While reinsurers may handle high severity risks, captives generally retain predictable cyber risks. D. Incorrect. Captives do not avoid technology risks. They address and manage them effectively. This question examines cyber risk insurance trends in captive operations. Question 10. Normal practice question. Topic: Financial and actuarial analysis. Which of the following is the primary purpose of actuarial certifications for captive insurance companies? A. Ensuring compliance with investment regulations. B. Demonstrating that the captive has adequate reserves to cover future claims. C. Verifying that the captive's policies are competitively priced. D. Confirming the captive's eligibility for tax exemptions. Answer B. Demonstrating that the captive has adequate reserves to cover future claims. Explanation B. Correct. Actuarial certifications validate that the captive has sufficient reserves to meet its obligations, ensuring solvency. A. Incorrect. Investment regulations are governed separately. C. Incorrect. Pricing validation is part of underwriting, but not the focus of actuarial certifications. D. Incorrect. Tax exemptions depend on other compliance factors. This question reinforces the role of actuarial analysis in financial oversight. Question 11. Normal practice question. Topic: Regulatory environment for captives in New Jersey. Which department oversees the regulation of captive insurance companies in New Jersey? A. The Department of Financial Services, DFS. B. The Department of Banking and Insurance, DOBI. C. The New Jersey Captive Insurance Bureau. D. The National Association of Insurance Commissioners, NAIC. Answer B. The Department of Banking and Insurance, DOBI. Explanation B. Correct. The DOBI is responsible for licensing, regulating, and monitoring captive insurance companies in New Jersey. A. Incorrect. DFS oversees financial services and insurance in other states like New York, not New Jersey. C. Incorrect. There is no specific bureau name. The New Jersey Captive Insurance Bureau. D. Incorrect. The NAIC is a national organization that provides guidelines but does not directly regulate captives. This question emphasizes knowledge of state-specific regulatory bodies. Question 12. Scenario question. Topic: Corporate governance in captive insurance. A New Jersey captive insurance company's board of directors is reviewing its risk management practices. They discover that one of their directors has been approving policies without proper documentation or actuarial justification. What is the best course of action for the board to ensure compliance and governance? A. Replace the director immediately and document the change. B. Conduct a governance review and implement clear policy approval guidelines. C. Inform the regulator and request an external audit. D. Suspend all policy approvals until an internal review is completed. Answer B. Conduct a governance review and implement clear policy approval guidelines. Explanation B. Correct. Establishing robust governance practices addresses the root cause and prevents future violations. A. Incorrect. While removing a director might be necessary, it does not resolve systemic governance issues. C. Incorrect. Informing the regulator is not required unless there is a regulatory violation. D. Incorrect. Suspending approvals is overly disruptive and unnecessary for isolated governance lapses. This scenario explores governance challenges and corrective strategies. Question 13. Normal practice question. Topic: Types of captive insurance companies. Which type of captive insurance company is structured to allow multiple unrelated entities to participate and share risks? A. Pure captive. B. Group captive. C. Rent-a-captive. D. Protected cell captive. Answer: B. Group captive. Explanation: B. Correct. Group captives are designed for multiple entities with similar risk profiles to pool and share risks. A. Incorrect. Pure captives serve only their parent organization. C. Incorrect. Renter-captives are owned by third parties and rented to businesses. D. Incorrect. Protected cell captives segregate risks, but are not specifically designed for unrelated entities. This question highlights captive structures and their purposes. Question 14. Normal practice question. Topic: Financial reporting requirements. Which financial report is required annually for New Jersey captive insurance companies? A. Quarterly risk exposure analysis. B. Statement of actuarial opinion. C. Investment strategy declaration. D. Market conduct examination report. Answer: B. Statement of actuarial opinion. Explanation: B. Correct. Captives must provide actuarial statements to demonstrate reserve adequacy and solvency. A. Incorrect. Risk exposure analysis is not mandated quarterly. C. Incorrect. Investment strategies are reviewed but not annually submitted as a separate report. D. Incorrect. Market conduct examinations occur periodically but are not submitted annually. This question ensures understanding of financial compliance requirements for captives. Question 15. Normal practice question. Topic: Reinsurance and captive insurance. What is the primary benefit of a captive insurer using reinsurance? A. Reducing premium taxes. B. Spreading high severity risks. C. Lowering operational costs. D. Increasing underwriting profit. Answer: B. Spreading high severity risks. Explanation: B. Correct. Reinsurance allows captives to transfer excess risk to reinsurers, protecting the captive's financial stability. A. Incorrect. Premium tax savings are not directly related to reinsurance. C. Incorrect. Reinsurance involves costs, not necessarily reducing operational expenses. D. Incorrect. Reinsurance can stabilize profits, but is not primarily for increasing them. This question focuses on reinsurance as a risk management tool. Question 16. Scenario question. Topic: Operational challenges in captive management. The risk manager of a New Jersey captive insurer identifies that claims payments are consistently delayed due to inefficiencies in the claims processing system. What is the best first step to resolve this issue? A. Outsource claims processing to a third-party administrator, EPA. B. Conduct an internal audit to identify bottlenecks in the system. C. Increase the number of employees in the claims department. D. Notify the regulator about the delays and request guidance. Answer: B. Conduct an internal audit to identify bottlenecks in the system. Explanation: B. Correct. An audit helps pinpoint inefficiencies, enabling targeted improvements. A. Incorrect. Outsourcing is a potential solution but should follow an assessment of internal issues. C. Incorrect. Hiring more staff without identifying root causes may not resolve the delays. D. Incorrect. Informing the regulator is unnecessary unless there are regulatory violations. This scenario examines problem-solving and operational efficiency in captive insurance. Question 17. Normal practice question. Topic: Risk retention strategies. Which of the following is an example of risk retention in a captive insurance structure? A. Purchasing excess insurance from a reinsurer. B. Establishing a loss reserve fund within the captive. C. Transferring risks to a fronting insurer. D. Opting for a claims-made policy instead of an occurrence policy. Answer: B. Establishing a loss reserve fund within the captive. Explanation: B. Correct. Retaining risk involves holding reserves to cover potential claims. A. Incorrect. Purchasing reinsurance transfers rather than retains risk. C. Incorrect. Fronting arrangements involve risk transfer, not retention. D. Incorrect. Policy type selection does not equate to risk retention. This question explores fundamental risk management concepts. Question 18. Normal practice question. Topic: Ethical considerations in captive management. What is the key ethical concern in captive insurance management? A. Avoiding premium tax entirely. B. Understating reserves to reduce reported liabilities. C. Disclosing policy terms and conditions transparently. D. Minimizing the number of policies issued. Answer: C. Disclosing policy terms and conditions transparently. Explanation: C. Correct. Transparency is essential to maintain trust and compliance. A. Incorrect. Avoiding taxes entirely may constitute fraud. B. Incorrect. Understating reserves is unethical and illegal. D. Incorrect. Policy quantity does not inherently relate to ethical concerns. This question highlights ethical practices in captive insurance operations. Question 19. Scenario question. Topic: Investment management for captives. A New Jersey captive insurer holds investments in highly volatile stocks. During an economic downturn, the captive incurs significant losses, threatening its solvency. What investment strategy could help the captive mitigate future risks? A. Concentrating investments in high-yield bonds. B. Diversifying the portfolio across asset classes. C. Shifting entirely to cash and equivalents. D. Investing primarily in real estate assets. Answer: B. Diversifying the portfolio across asset classes. Explanation: B. Correct. Diversification reduces the impact of volatility in any single asset class. A. Incorrect. High-yield bonds carry their own risks. C. Incorrect. Shifting entirely to cash limits growth potential. D. Incorrect. Real estate investments may lack liquidity during downturns. This scenario evaluates investment strategies for captives. Question 20. Normal practice question. Topic: Emerging risks in captive insurance. Which emerging risk is increasingly being addressed by captive insurance companies? A. Flood insurance. B. Climate change liabilities. C. Homeowner property damage. D. Commercial auto insurance. Answer: B. Climate change liabilities. Explanation: B. Correct. Captives are crafting solutions for risks associated with climate change, such as severe weather events and carbon credit insurance. A. Incorrect. Flood insurance is a traditional risk rather than an emerging one. C. Incorrect. Homeowner risks are typically insured through personal lines, not captives. D. Incorrect. Commercial auto is also a conventional risk. This question assesses knowledge of new challenges in the captive industry. Question 21. Normal practice question. Topic: Risk financing in captives. Which of the following best describes risk financing through a captive insurance company? A. Transferring all risks to external insurers. B. Retaining and managing risks within the captive structure. C. Utilizing a captive to secure government subsidies. D. Outsourcing claims management to third-party administrators. Answer: B. Retaining and managing risks within the captive structure. Explanation: B. Correct. Captives are designed to retain and finance risks internally, giving the parent company more control. A. Incorrect. Captives retain risks rather than transferring all of them. C. Incorrect. Government subsidies are not related to captive risk financing. D. Incorrect. Outsourcing claims management is operational, not financial, in nature. This question focuses on the core purpose of captives in risk management. Question 22. Scenario question. Topic: Compliance challenges. During an audit, the compliance officer of a New Jersey captive insurance company discovers that the financial statements submitted last year had minor inaccuracies due to a software error. What is the most appropriate action the compliance officer should take? A. Inform the Department of Banking and Insurance. Dobate immediately and submit corrected statements. B. Ignore the errors as they are immaterial. C. Wait until the next annual submission to correct the errors. D. Update the software and ensure accuracy in future submissions without informing the DOBI. Answer: A. Inform the Department of Banking and Insurance. DOBI immediately and submit corrected statements. Explanation: A. Correct. Proactively addressing inaccuracies maintains trust and regulatory compliance. B. Incorrect. Even minor errors should be corrected to ensure transparency. C. Incorrect. Delaying corrections could lead to compliance issues. D. Incorrect. Errors must be disclosed, not just corrected internally. This scenario tests understanding of regulatory compliance and ethical responsibility. Question 23. Normal practice question. Topic: Types of risks in captives. Which type of risk is a captive most commonly used to insure? A. Catastrophic risks only. B. Routine and predictable business risks. C. Speculative risks like market investments. D. Non-quantifiable risks. Answer: B. Routine and predictable business risks. Explanation: B. Correct. Captives are typically used for manageable, predictable risks such as workers' compensation or professional liability. A. Incorrect. Captives can handle catastrophic risks but often rely on reinsurance for such exposures. C. Incorrect. Speculative risks are not insurable. D. Incorrect. Captives address quantifiable risks. This question focuses on appropriate risk types for captive insurance. Question 24. Normal practice question. Topic: taxation of captives. Under U.S. federal tax law, captives can often deduct premium payments as A. capital expenses, B. operating expenses, C. non-deductible reserves, D. deferred liabilities. Answer: B. operating expenses. Explanation: B. Correct. Premium payments to a captive may be deductible if the captive qualifies as a legitimate insurance company. A. Incorrect. Premiums are not considered capital expenses. C. Incorrect. Deductible reserves are different from premiums. D. Incorrect. Premium payments are not deferred liabilities. This question explores tax implications for captives. Question 25. Scenario question. Topic: risk pooling. A group of small businesses in New Jersey forms a group captive to insure against cybersecurity risks. And after a major data breach affects one member, the captive faces liquidity challenges. What is the best strategy to address this situation? A. Increase premiums for all members immediately. B. Utilize reinsurance to cover the excess losses. C. Liquidate the captive and distribute losses. D. File a bankruptcy petition for the member affected. Answer: B. Utilize reinsurance to cover the excess losses. Explanation: B. Correct. Reinsurance provides additional protection for catastrophic losses, maintaining the captive solvency. A. Incorrect. Raising premiums without addressing liquidity may not resolve immediate challenges. C. Incorrect. Liquidation should be a last resort. D. Incorrect. Filing for bankruptcy is not a responsibility of the captive. This scenario demonstrates the importance of reinsurance in group captives. Question 26. Normal practice question. Topic: protected cell companies. What is the primary benefit of using a protected cell captive structure? A. Limited liability protection for parent companies. B. Segregation of assets and liabilities between cells. C. Elimination of reporting requirements. D. Simplified licensing process. Answer: B. Segregation of assets and liabilities between cells. Explanation: B. Correct. Protected cell structures isolate each cell's assets and liabilities, preventing cross-contamination. A. Incorrect. Liability protection is limited to each cell. C. Incorrect. Reporting requirements remain even for cell captives. D. Incorrect. Licensing is not necessarily simplified. This question focuses on structural benefits of protected cell captives. Question 27. Normal practice question. Topic: captive exit strategies. What is a common exit strategy for a captive insurance company? A. Conversion to a traditional insurer. B. Distribution of reserves and dissolution. C. Transferring liabilities to shareholders. D. Outsourcing operations to a third-party administrator. Answer: B. Distribution of reserves and dissolution. Explanation: B. Correct. Captives often wind down by paying claims, distributing reserves, and dissolving. A. Incorrect. Captives rarely convert to traditional insurers. C. Incorrect. Liabilities are not transferred to shareholders. D. Incorrect. Outsourcing operations is not an exit strategy. This question examines end-of-life options for captives. Question 28. Scenario question. Topic: claims handling. A captive insurer is facing a dispute with a claimant over a denied workers' compensation claim. The claimant alleges a violation of good faith handling practices. What should the captive's claims department prioritize to resolve the dispute? A. Seek legal counsel and prepare for litigation. B. Review the claim file and ensure compliance with policy terms. C. Offer a settlement to avoid escalation. D. Notify the regulator immediately about the dispute. Answer: B. Review the claim file and ensure compliance with policy terms. Explanation: B. Correct. Reviewing the claim ensures the denial was justified and in compliance with terms. A. Incorrect. Litigation is costly and should not be the first approach. C. Incorrect. Settlements may not address root issues. D. Incorrect. Notification is unnecessary unless legal violations are evident. This scenario tests ethical and procedural claims handling. Question 29. Normal practice question. Topic: solvency requirements. Which of the following metrics is commonly used to assess a captive solvency? A. Loss frequency ratio. B. Combined ratio. C. Risk-based capita RBC ratio. D. Policy retention rate. Answer: C. Risk-based capital, RBC ratio. Explanation: C. Correct. The RBC ratio measures the adequacy of a captive's capital relative to its risks. A. Incorrect. Loss frequency ratio evaluates claims frequency, not solvency. B. Incorrect. Combined ratio measures profitability, not solvency. D. Incorrect. Retention rate measures customer loyalty, not solvency. This question highlights solvency metrics for captives. Question 30. Normal practice question. Topic: Underwriting in captives. What is the primary consideration when underwriting risks for a captive insurance company? A. Competitive market pricing. B. Parent company's risk tolerance. C. Securing external reinsurance agreements. D. Compliance with international regulations. Answer: B. Parent company's risk tolerance. Explanation: B. Correct. Captives align underwriting practices with the parent company's risk appetite. A. Incorrect. Captives are not market competitors. C. Incorrect. Reinsurance supports underwriting but is not the primary consideration. D. Incorrect. Captives often operate under local regulations rather than international ones. This question emphasizes tailored underwriting practices in captives.